There is a pattern in the data that does not resolve easily. Over the past 3 years, a significant number of governments have made formal public commitments to reducing their dependence on the US dollar. In trade settlement, in reserve holdings, in bilateral payment arrangements. Some of these commitments have been specific, some have come with timelines, and yet, across the same 3-year period, the same governments have continued to issue sovereign debt denominated in dollars at rates that have not meaningfully declined. Brazil issued dollar-denominated bonds in 2023 and again in 2024. Saudi Arabia's latest sovereign sukuk was dollar-denominated. Even Russia, operating under the most severe dollar exclusion conditions of any major economy, has seen its commodity export revenues routed through intermediary currencies that are themselves pegged to or benchmarked against the dollar. The stated policy and the financial behavior are not the same policy. This is not a small discrepancy you can explain away with transition costs or institutional inertia. Sovereign debt issuance is a deliberate decision. It involves legal counsel, investor roadshows, currency risk modeling. When a government chooses to denominate its debt in a foreign currency, particularly the currency it is publicly committed to displacing, that choice reflects something about the alternatives that the public position does not. I've been turning this over for a while, and the direction it keeps pointing is not flattering to either side of the conventional argument. The dollar pessimists point to BRICS trade volumes, to the Yuan's expanding bilateral reach, to the number of countries now holding non-dollar reserve assets above 10% of their total holdings. These are real numbers. They describe a real trend. The dollar optimists point to the dollar's share of global foreign exchange reserves still above 58%, and to SWIFT transaction data showing dollar dominance in cross-border payments has barely moved. These numbers are also real. Both camps are looking at genuine evidence. The disagreement is not about the data, it is about which layer of the system the data describes and which layer actually determines outcomes. The layer the trade volume argument describes is the transaction layer, which currency appears on the invoice when oil moves from Riyadh to Beijing, when soybeans leave Santos for Shanghai. That layer has genuinely shifted. More of those invoices are denominated in yuan, in rupees, in dirhams than 5 years ago. If you are measuring de-dollarisation by invoice currency, the trend is real and it is accelerating. The layer the reserve data describes is deeper. It is the store of value layer, the question of what governments hold when they want to hold something safe. That layer has moved much less, and the question of why it has moved less, despite obvious political motivation to move it more, is where the interesting argument lives. Somewhere between those two layers is a third one that receives less attention, the debt issuance layer, the question of what currency a government reaches for when it needs to borrow at scale, under pressure, in conditions it did not anticipate. That layer is the most honest signal of all. It is where stated policy meets the arithmetic of credibility. At the 2023 BRICS summit in Johannesburg, the bloc released a declaration that contained language on a proposed common payment mechanism, referenced as a framework for reducing third currency dependency in intra-BRICS trade. Buried in the technical annex to that declaration was a clause specifying that any interim settlement instrument would require reserve backing in currencies with established swap lines. The list of currencies with established swap lines at the required scale included at that point exactly one, the US dollar. The summit was covered primarily as a story about expansion. 6 new members, the growing weight of the global south, the symbolism of a Johannesburg gathering challenging the Washington-led order. The technical annex received almost no coverage. The argument being made publicly at that summit and the architecture specified quietly in its annexes were not the same argument. And that gap between what the movement declares and what it actually requires to function is where the real accounting has to happen. To understand why that gap exists, you have to understand what a reserve currency actually does, not in the textbook definition, but in the operational reality of how governments and institutions behave under stress. The textbook version says a reserve currency is simply one that other countries hold in large quantities for trade and savings. That description is accurate but incomplete in a way that matters. It describes the output without describing the mechanism that produces it. The reason countries hold a currency in reserve is not because they have decided to trust it in the abstract. It is because the liabilities they need to service, their debt obligations, their import contracts, their currency defense commitments, are denominated in it. You hold dollars because you owe dollars. The reserve position is downstream of the liability structure, not upstream of it. This is why the transaction layer and the reserve layer move at different speeds. Changing invoice currency is a bilateral negotiation. Two parties agree to settle in yuan instead of dollars. That transaction is complete. But the liability structure of a sovereign balance sheet is not bilateral. It is the accumulated result of decades of borrowing decisions, debt rollovers, and credit relationships with institutions that themselves operate in dollars. You cannot renegotiate that structure in a summit declaration. You can only renegotiate it one maturity at a time, at a cost that rises whenever your alternative currency loses credibility and falls whenever the dollar strengthens. The yuan's expansion at the transaction layer has been real, and it has been faster than most analysts predicted a decade ago. Bilateral currency swap arrangements between the People's Bank of China and central banks across Southeast Asia, the Middle East, and Latin America now cover a combined nominal value exceeding $4 trillion, the yuan equivalent, which itself requires a dollar reference to communicate. Intra-BRICS trade settled in non-dollar currencies has increased as a share of total BRICS trade. These are not trivial movements. They represent institutional decisions made at the highest levels of multiple governments, sustained over years, with real infrastructure built to support them. The conventional case for de-dollarization acceleration rests on this foundation, and it is a stronger case than it is usually given credit for. The argument runs like this. The transaction layer leads the reserve layer. As more trade settles in alternative currencies, the need to hold dollar reserves to service that trade decreases. As dollar reserve holdings decrease, the political and institutional cost of further reducing them also decreases. The transition is self-reinforcing once it reaches sufficient scale. And the trade data suggests it is approaching that scale in certain corridors, particularly the China Gulf Energy Corridor, where UN-denominated oil contracts have moved from symbolic to substantial. That argument has genuine weight. I want to be clear about that before I show where it runs into the record, because the version of the counterargument that dismisses yuan internationalization as purely performative is not accurate and it is not useful. Something real is happening at the transaction layer. The question is whether the mechanism the conventional case describes, transaction layer changes pulling the reserve layer behind them, is actually operating, or whether something else is operating instead. The evidence for the mechanism's limits comes from the liability side of the ledger, not the asset side. The countries most aggressively pursuing transaction layer de-dollarization, the ones whose trade invoicing data shows the clearest shift, are also the countries whose sovereign debt issuance data shows the most persistent dollar dependence. Brazil's central bank has expanded its yuan swap capacity. Brazil's treasury has continued issuing dollar bonds. Saudi Arabia has joined every non-dollar payment initiative its Gulf neighbors have proposed. Saudi Arabia's external financing remains overwhelmingly dollar-denominated. The pattern is not random. It reflects the difference between a country's ability to choose its invoice currency, which is a negotiation with a trading partner, and its ability to choose its borrowing currency, which is a negotiation with global capital markets. Global capital markets do not accept UN-denominated sovereign debt from non-Chinese issuers at scale. The buyer base does not exist at the depth required. And without that buyer base, the liability structure stays dollar-denominated, which means the reserve requirement stays dollar-anchored, which means the reserve layer does not follow the transaction layer. The self-reinforcing transition the conventional case describes requires a step that has not yet happened. The strongest version of the conventional case does not ignore the liability problem. It answers it with a timeline argument. The yuan's internationalization is early stage, the argument goes. The offshore yuan bond market, the dim sum market, is growing. The Shanghai Cooperation Organization has produced frameworks for local currency financing. The new development bank, the BRICS lending institution established in 2015, was specifically designed to provide infrastructure financing in member currencies, reducing the need for dollar-denominated external debt. These are institutional responses to exactly the liability problem the de-dollarization skeptics identify. The machinery is being built. The timeline is decades, not years. Measuring the reserve layer now and declaring the project failed is like measuring container ship orders in 1955, and concluding globalization will not happen. That is a serious argument. The timeline reframe is probably the most intellectually honest version of the pro-de-dollarization position because it does not deny the current liability structure. It contextualizes it as a transitional condition rather than a permanent one. And the new development bank is real. It has disbursed real financing. The local currency lending mandate is genuine policy, not decoration. The new development bank had, as of its most recent annual report, disbursed approximately $32 billion in total financing since its founding. 40% of that disbursement was in local currencies. The remainder, the majority, was dollar denominated because borrowing member governments requested dollar disbursements, not because the NDB required it, because the governments themselves, when the moment of actual borrowing arrived, reached for the currency their liability structures required them to service. The institution built to solve the dollar dependency problem was asked by the countries it was built to serve to perpetuate dollar dependency, because the alternative required those countries to absorb currency risk on their balance sheets that their fiscal positions could not carry. That is not a transitional condition. That is the mechanism revealing its own constraint, which brings the argument back to Johannesburg and to the clause that the 2023 BRICS Summit Declaration buried in its technical annex, the one specifying that any interim settlement instrument would require reserve backing in currencies with established swap lines. That clause was not an oversight. It was not diplomatic boilerplate inserted by a junior working group. It was a technical requirement written by people who understood what a payment mechanism actually needs to function: liquidity, convertibility, a lender of last resort capable of standing behind the instrument under stress. The movement, publicly committed to ending dollar dependency, wrote a document that specified dollar infrastructure as the prerequisite for its own alternative, not as an intermediate step toward something genuinely independent, as the load-bearing requirement of the system itself. The timeline argument says the machinery is being built. The annex says the machinery, as currently specified, requires the foundation it is supposed to replace. What I find harder to dismiss the longer I look at the record is that this is not a failure of political will or a temporary shortfall of institutional capacity. It is a structural condition that the de-dollarization movement has not resolved at the theoretical level, let alone the practical one. The alternative to dollar infrastructure is not Yuan infrastructure plus time. It is a genuinely different architecture for how sovereign credit risk is priced and who absorbs it when things go wrong. No such architecture has been designed. The NDB disbursement data is not evidence that it is being designed. It is evidence that when the choice is real rather than rhetorical, the existing architecture wins. The countries leading de-dollarization are not failing to execute a viable plan. They are executing a plan that was not viable at the design stage, and the annex was the moment they acknowledged it in the only language that matters, which is the language of technical requirements rather than political declarations. The conclusion I've landed on, after working through the strongest version of the counterargument, is that de-dollarization is real at the layer where it costs nothing and stalled at the layer where it costs something. The transaction layer is moving. The liability layer is not, and the liability layer is the one that determines whether the reserve layer ever follows. The verdict is not that the dollar is invulnerable. That is a different argument and a weaker one than the evidence supports. The dollar faces genuine long-term pressure from fiscal trajectory, from the political weaponization of SWIFT access that has accelerated every non-dollar payment initiative since 2022, from the simple demographic and economic weight of the countries that would prefer an alternative. Those pressures are real. They will continue to build. Anyone who reads the de-dollarization trend as purely performative is missing something important about the direction of institutional intent across a significant portion of the global economy. The verdict is more specific than that. It is that the de-dollarization movement has consistently overstated its own progress by measuring the layer that has moved while treating the layer that has not moved as a downstream consequence rather than a prerequisite. The transaction layer shift is real. Layer shift. But it is not pulling the reserve layer behind it because the liability structure that anchors the reserve layer is not determined by invoice currency. It is determined by who will buy your debt, at what price, under what conditions, when you need to borrow under pressure rather than under calm. That buyer base remains dollar denominated in its requirements. Until it does not, the reserve layer stays where it is. The specific prediction worth making, specific enough to test with a defined time frame, is this. By the end of 2027, the share of new development bank disbursements in local currencies will not exceed 50%, despite the institution's stated mandate and the political pressure from member governments to demonstrate progress. The constraint is not political will, it is the fiscal capacity of borrowing members to absorb currency risk on infrastructure timelines. That capacity will not materially change in 3 years. The disbursement data will continue to show the same pattern the current data already shows. Member governments requesting dollar disbursements from an institution that exists to offer something else. If that prediction is wrong, the mechanism I have described is wrong. That is the test. The forward implication beyond that prediction is less comfortable. The countries that have invested most heavily in the infrastructure of de-dollarisation, the payment mechanisms, the swap lines, the alternative lending institutions have built systems that currently require dollar architecture to function. That is not a temporary condition they will grow out of. It is a design constraint. And design constraints, once load-bearing, tend to persist, not because no one wants to change them, but because changing them requires absorbing costs that no single actor in the system has the incentive to absorb alone. The dollar's durability at the reserve layer is not a function of American power in the traditional sense. It is a function of a collective action problem that the de-dollarization movement has not solved and has not yet seriously attempted to solve, which returns the argument to where it started, to the pattern in the data that does not resolve easily. Governments publicly committed to reducing dollar dependence, continuing to issue sovereign debt in dollars. That pattern looked at the start like a contradiction, like a gap between stated policy and revealed preference that might close as alternatives matured. It does not look like a contradiction anymore. It looks like an accurate self-assessment, expressed in the only language that cannot be diplomatic. Sovereign debt issuance is where a government shows what it actually believes about its options, stripped of the political framing it uses for summits and declarations. And what these governments have been showing consistently across multiple issuance cycles is that they believe the dollar alternative is not yet real at the layer that matters, not because they lack the political motivation to use it, but because the architecture does not yet exist to support it. The 2023 BRICS summit was covered as a story about momentum, about the gathering weight of a multipolar challenge to dollar dominance. That reading was not wrong about the intent, it was wrong about what the documents actually said. The declaration announced an alternative. The annex specified that the alternative required the thing it was replacing. That is not momentum toward a post-dollar order. That is a description of how far away one still is. Tell me where I'm wrong. The comments are open.